Hi, Peter Rose, Longwood Currency Trading. I was digging around through some old papers and stuff, and I stumbled on a quote from Jesse Livermore, and it kind of hit me as something that I've talked about in a couple of videos and also a few of my blog posts. A little bit different swing on it, so I wanted to cover that today because I think it'll help pull some of the other stuff that I've talked about together a little more. Livermore said to anticipate the market is to gamble. To be patient and react only when the market gives the signal is to speculate. And I found this really interesting in light of the work that I did on the other videos and blogs that I've done, is because I've talked about speculating being different than the longer term traders, even the swing traders approach to trading, even a day trader's approach. Speculating indicates just your fingers on the trigger all the time, boom, 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 boom. Whereas a swing trader is going to wait for a trade to come to them, and they'll ride that through the course of the day for 10 or 20 pips or whatever they can get, 40 pips. And then you go into long term, you go into trading intraday or multi-day on the 1 hour charts maybe, or if you're up on the weeklies, you could trade on the month. So the longer term is kind of a really broad reaching category, I think, whereas when you get down to parsing day trading and speculating and swinging, you're more restrictive in how you're defining things. What's interesting is that we know Livermore was a speculator when he was in the bucket shops, that he'd sit there and speculate. There were no, he'd trade multiple times a day, and even in his later years he would speculate, but also he was a master of the long-term hold and the enormous risks that he took by letting price retract against him, because he just said, I know that I'm right, and I'm going to hold on to these positions, and we're just going to see what happens. And he would just take horrendous losses, and then he'd either be vindicated, or the 4 or 5 times that he went broke were because of those things. He was pretty stubborn and didn't want to get out. So here's the anomaly, is that Livermore in this quote is talking about not doing anticipatory trades and being patient and waiting for the market to give its signal is the hallmark of a speculator. So I think he's defining speculation a little differently than I have in the past, and I think the way that we generally tend to look at speculators. I kind of categorize myself, well, first of all, let's be broad-based in the definition of speculator. A speculator is someone who takes, or as I have defined it before, assumes risk and is willing to accept smaller term gains for a longer term overall result. They're not afraid to jump in and play the game. It's like a stock car racer going around the track 200 or 300 times versus a drag racer. It's just you're still driving a car. It's just the distance that you determine that you're going to cover. I think some people enjoy drag racing, whereas other people, they may not. They may think that it's too risky. Whereas a drag racer would look at the lap racer as someone who's just sitting there steering the car. They're equally dangerous activities, as is trading. It's dangerous to speculate. It's dangerous to long-term trade as well. And I've gone over those differences many times. But what I think is interesting is that Livermore, in his quote, seems to be blending all of trading, all of the different categorizations of trading under the term speculator. I'm speculating on what the market is going to do. It's not like drag racing or going around the track where you say, look, I've got X number of rubber on the tires, I got so much gasoline, the engine's tuned up to go, it's put out so much torque and get me off the line in a certain period of time. You can sort of preset your activity. And then when you put your car on the line, what it's going to do is predictable. It's not predictable whether you're going to win, but you're not going to lose unless, you know, there's an accident or something. So it's just a matter of how much you're going to win, I think is what it comes to. Where I think in the speculative world, you don't know any of the outcome, and you don't really know the start either. Each time you go for a trade setup, it's a different setup, right? I mean, that's just the way that it seems to be. So I think there's a blend there. I think Livermore's quote is very revealing in that trading is speculating. I think the two terms are synonymous with each other, and it's just us that particularly says we want to identify ourselves as primarily we're going to be a speculator, or we're going to be a long-term trader on the daily charts, for example. I think that it would be very difficult, and I've said this in other videos before, for the longer-term trader to come down and be successful at speculating. I don't think there's that transfer process. However, I think the speculator is easily able to transition to the longer-term trading aspects. And in fact, isn't that what Livermore did? He started out as a raw speculator on the moment, and turned into trades that he would hold for weeks. So, and I think that's what made him a good long-term trader. I think if he would have started out as a long-term trader, he would have never gone into speculating. Warren Buffett is very, very successful as a long-term trader, and he doesn't like this. He doesn't speculate. He doesn't trade. He wouldn't do that. Paul Tudor Jones, tremendous speculator on the short term. There's a marvelous video of him when he was younger trading. It's a really dynamic view of what a speculator is like, what it's like to speculate privately. I mean, you could look at speculators on the commodity floor, and there's certainly plenty of videos of that going on. But a master like Tudor Jones, it was just a wonderful video. He's tried to pull that off of the internet. Every time you see it posted somewhere, it'll get jerked off. Because I don't think he wants that image of him now that he's a statesman of trading, a responsible investor. Because he was a cowboy. He was a sight to behold when he was trading. So I think that doing both aspects of trading will make you a better trader. But I don't think you need to be a speculator to be a good long-term speculator. And I don't think you need to be a long-term trader to try to understand the nuances of speculating. You pick one aspect that you're comfortable with. You want to trade on a 15-minute chart? Great. You want to trade on a 5-second chart? Well, great. You know, because price action, as I've said many times, is fractal. You know, you look at the satellite view of the coast of Maine, for example, and you see its jaggedness, and then you bring it down to maybe a drone picture several hundred feet off the ground, and it looks the same kind of jaggedness. You get down and peer at the shore that you're walking along, and it's fractal. You look at a leaf edge, and you look at the edge part of it, and it's fractal, and you look at the edge part of that, and it's fractal. Trading is fractal, so whether you're trading a 5-second chart or a daily chart, you wouldn't know what chart you're on simply by looking at the price action without the time scale or the price scale. So yes, and there is a lot of noise at the 5-second chart, and I'm not sure that you're not really trading. Let's say that if you're trading on a 15-minute chart, you've got a 20 or 30 pip profit target, and then if you're trading on a 5-minute chart, you may be down to a 15 pip target, and if you're down at a 1-minute chart, you may be trading at a 5 or 6-minute target. That doesn't necessarily mean that you're at a 5-second target, that you're trading at a 2 pip thing, because just the VIG that the brokers are charging you, the spread, that isn't gonna work. That isn't gonna work at all. But you can see patterns beginning to build in the if you've ever looked at the 5-second chart, you can see them beginning to form in little clusters, and then when that 5-second price action begins to break out of that cluster, you could jump up to the 1 minute chart and see that manifest itself at the 1 minute. I've long said that the dog in all the trading is that 5-second chart. What you see happening on that 5-second chart from a trending standpoint is going to manifest itself out on the 1 minute chart very quickly, and then much later the 5-minute chart, the 15-minute chart, ultimately out on the hourly chart. So you can look at the hourly chart and you just see it's barely moving at all. But if you're down on the 5-second and 1 minute chart, you could be going through ranges of 5-10 points, and not even see them on the hourly chart. But those 5 and 10 point moves could be precursors to that 1 hour or that daily chart beginning to move in direction. It also is an indication at the 5-second level of the momentum. So as a speculator, you're looking at those lower time frames for those kinds of signals that enable you to either trade down there. You say, well, look, the signals, I can grab 3 or 4 points here. I think I'll grab that. Or you could say, hey, this is setting up for something a little bit larger. Let me take a look out at the 15-minute. Let me look at what the structure is around that 15-minute time frame, and let's see what's going on. Oh, gee, look at the 1 hour. There's a whole cluster of 15-minute crap that's going on up here higher on that 1 hour chart. So instead of setting a 15 pip target, I'll set a 50 pip target. So you have to be flexible, and I think that's what Livermore is saying in his quote, is that you don't anticipate the trade. You have to wait until something happens to manifest a directional bias to all the people that are trading that contributes to price action moving in a particular direction. So I think we have to look carefully at those terms of long-term trader and speculator and all the rest, and you shouldn't do one, and you should always do this, and you shouldn't have profit targets less than 50 pips because there's too much chatter going on, and your risk is 25 pips, and you could get chatter of 10 or 15 pips. It all depends on the chart frame that you're looking at, right? Because again, price action is fractal, and so in my videos, I will continue to refer to myself as a speculator because I'm willing to take 2 or 3 pips when I see price action beginning to degrade. I'm not going to hang around for it to turn around and hit my stop because I want to have a fairly good win-to-loss ratio so that I'm on the train when those big moves do occur. I don't want to be sitting on the sidelines waiting so that I've got structure to give me X amount of risk tolerance to the trade to take. So anyway, I just thought I'd bring that out as an interesting kind of blend between what we traditionally look at as a speculator as opposed to a long-term trader. It's just trading. Doesn't matter whether you're trading Forex or commodities or stocks or old tires. I mean, it's trading. It's for sale, right? And so we just all do the best that we can with the time frame that we're comfortable with, and that's the key to the thing. And it's not just comfortable. Oh, I'm comfortable sitting here in this stool. It's your personality. It's your character. If you're looking for action, don't be trading out on the daily chart. If you're looking for action and you want to trade, go down and trade the 5-minute or the 1 minute. Be a speculator in terms that the speculator is geared at. If that makes you nervous and you work during the day and you can't do anything, hey, trade off on the daily charts. You come home at night and check the 5 o'clock close, make your plans up for what's going to happen, and place your trades based on that. There's a lot of people that do that, and they're very successful. But you know, there's a lot of people that are speculating that are successful as well. There are not as many people speculating that are successful as there are the longer term traders who are successful, simply because there are way too many morons that start out speculating without knowing shit from Shinola about what they're doing, and they get cleaned out pretty readily on 100 to 1, 200 to 1 leverage if they're in places where they do that. And you know, all these signal services and multi-level scam places, they all are very short-term signal based for taking trades, and to encourage the churn, because the broker's giving them kickbacks for having the client there, and the broker's making money because they're carrying the trades. They're not an ECN broker. They're trading the other side of taking the other side of the trade, because they know they're going to win 90% of the time. Why wouldn't you? It's like free money. So yeah, it would appear that speculating is more dangerous. But if you do your study and you do your analysis and you do your practice runs in the sim account, and you go into this live account with a small amount of money so that you can hone your craft, you're not facing any more risk than you would be if you were trading on a daily chart. You're really not. And there's enough folks out there that prove that to be the case. So anyway, Livermore's quote, "To anticipate the market is to gamble. To be patient and react only when the market gives the signal is to speculate." That's from the master himself, Jesse Livermore. Thanks for watching my video. I hope you made it all the way through so that it ultimately made sense to you. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.